Hi friends, welcome to the ABFM Unit Crash Course, and we are discussing financing and operating leverage. So let's get started with financial leverage ratio. So you can think of there are some ratios which has been given. So the first ratio is called interest coverage ratio, right? So what is interest coverage ratio? It tells us that how much interest. In the numerator you can see EBIT, in the denominator you can see interest expense, right? It tells us how much easily company can pay it interest, right? So that is what interest coverage ratio tells us. Obviously company has borrowed money, so obviously it will have to pay interest, right? So how much easily company is able to do the interest payment, that is what interest coverage ratio tells us, right? And the formula is EBIT upon interest expense. So what does EBIT indicate? EBIT indicate the net profit before interest, paying interest and tax, and from that profit only from that earning only company will be paying interest. So more EBIT, so more ability to pay interest. So EBIT upon interest expense is called interest coverage ratio. Then we have equity multiplier. So what does equity multiplier tells us? It also tells us how easily company can make it interest payment. Higher the equity multiplier, if we talk about the equity multiplier, it shows us as a total asset upon total equity, right? That means how much asset, right, is getting funded by equity, right? So if it is more, it means leverage is also higher, right? If more asset is funding by equity, it means our leverage is also higher. Then we have debt EBITDA ratio. So what does debt EBITDA ratio means? Means how much early company can repay its loan using it earning. That is debt to EBITDA ratio, right? So if this ratio is lower, it means better financial health. So basically what this ratio tells us, how easily company can pay back its loan using it earning. So EBITDA is the earning and debt is the total debt it has taken. So if this ratio is lower, it means that it is better financial, it shows better financial health. Then we have debt equity ratio. So as the name itself suggests, it compares debt and owner's equity. So if debt portion is higher, it means risk is more. Then we have debt to asset ratio. So this ratio tells us how much portion of the company's asset is funded by the debt, right? Again, the lower the ratio, the better it is, right? So you see, we have discussed 5 different ratios. On those ratios where debt is in numerator, that ratio should be lower, right? And for those ratio where interest expense EBIT is in numerator, those ratios should be higher. That is the basic funda. So these 5 ratio when combined, right, they decide the financial structure of a company, right? So interest coverage ratio means how easily company can pay back its interest using it earning. Equity multiplier means how much of the asset is funded by the equity, because to fund asset either we use equity or we use the debt, right? So equity multiplier, I told you the equity multiplier, if it is higher, it means leverage is also higher. Then we have debt the debt EBITDA ratio means how much it basically it shows that how early company can pay back its debt using it earning. If this ratio is lower, better financial health. Debt equity ratio, debt and owner contribution comparison is being done using this ratio. And debt asset ratio, that means how much of the asset is funded by the debt. Like debt equity ratio, similarly we have debt asset ratio. Lower it is better. Now friends, let's shift our focus to the financial leverage, right? So we have discussed 5 ratios earlier, financial leverage ratio. Now financial leverage, you can think of it like double-edged sword. It amplifies your return on equity when used wisely, but if you overuse it, especially by large firm, it can be dangerous. So what happened? So that is why I have written double-edged sword, right? Why it is double-edged sword? I told you na, right? It can amplify your return on equity. This ROE means return on equity. It can increase your return on equity if you use it wisely. But if you overuse it, by large firm, what they do, they overuse it, it can be dangerous. A small business might tolerate higher leverage, but larger corporation need to treat cautiously. Right, so that is why optimal mix is required. Mixing between equity and debt is optimal, it should be required. Right, so the goal is to strike the optimal mix between equity and debt, and that is where CBA, what is CBA? Cost benefit analysis and proper funding strategy comes into play. Then we have something called risk management. So risk management is all about balancing gain with stability. You can see balancing risk and return in leverage. So risk management is all about you are balancing gain with potential gain with financial stability. So more debt, it means more profit, but only if managed smartly. Suppose you have taken more debt. Oh, you are happy that yes, I have more profit. But remember, at the back of mind, you must keep in mind, if you manage that debt smartly, then only it is profitable. Otherwise, it will not be profitable. You have to manage that debt smartly. Right, now comes degree of financial leverage. It is a tool that shows how sensitive earning per share is to the change in the operating income. So the formula is percentage change in EPS upon percentage change in EBIT, and here is the simplified version. Right, what is the simplified version? That if interest is fixed, then we can write DFL is equal to EBIT upon EBT. You can see it here, since interest is fixed, right? So delta EBIT is equal to EBI per delta EBT. So the final formula is, you must remember this formula, EBIT upon EBT, right? So that is earning before interest and tax divided by earning before tax. And finally, some more important formula that will help you to solve the problem is that suppose sales is given, variable cost is given, fixed cost is given, you have been asked to calculate EBIT, how to go about doing that. So what you do, first of all, you take the sale, you subtract variable cost, and you also subtract the fixed cost excluding interest. Right, you also subtract the fixed cost from that, and then you will get EBIT. And suppose we know the EBIT, how to get EBT? Quite simple. EBIT means what? Earning before interest and tax. EBT means what? Earning before tax. So just subtract the interest from EBIT, we will get EBT. So these two formula will be very useful to you, right, while doing the calculation, so while calculating the DFL. Right, so remember these two formula, very important from examination point of view. So to summarize the fact that we have covered in this particular slide, let me tell you that this financial leverage, it can be your best friend or it can be your biggest risk. Handle it with insight and it can drive powerful growth. Now friends, so I hope this financial leverage concept is clear. Then comes degree of financial leverage. So after financial leverage, the next important topic is degree of financial leverage. What is the meaning of degree of financial leverage? Let's understand. So friends, basically there are three scenario here. First scenario on the left hand side is there when there is no interest. So when no interest, what will happen? EBIT is equal to EBT, because no interest is there, no debt part is there. No interest means what? You have not taken any debt, hence no interest to pay. In that case, DFL will be equal to 1. This means there is no leverage effect. So this interpretation should be there. You should know what is the meaning of DFL is equal to 1. So whenever DFL is equal to 1, it means EBIT and EBT both are equal. It means that no debt has been taken, no leverage effect is there, profit change in line with the operating income, safe but limited upside. It is quite safe, but there is no chance of gaining too much. So that is why upside is limited. Right, okay. Now this is situation number 2, that is called break even. So break even means what? Break even means neither profit nor loss. Right, you are neither making profit, you are not making loss. Right, so what will happen? What will happen in this case? Your EBIT, which is your earning, which be exactly equal to the interest. Interest means the cost you are paying. Because you have taken debt, obviously you are paying interest on that is the cost you are paying, and EBIT is your earning. So what I told you, break even, no profit, no loss. Right, so no profit, no loss means what? Whatever cost you are incurring and whatever sales you are getting, both are same. Cost price is equal to selling price. That is what it is happening here. Right, and tell me what will happen to the DFL? So DFL is what? EBIT upon EBT, and EBT is 0. Obviously EBT is 0, earning before tax is 0. Right, so EBT is 0. Since EBT is 0, it means denominator is 0, and denominator means 0 is undefined. It means it is undefined. So this is the maximum risk zone. This is called maximum risk zone. Even a tiny dip in EBIT can lead to huge loss. Suppose EBIT decreases a little, it will lead to huge loss, a dangerous place for any business. So break even point is the dangerous place for any business. This is the situation number 2. And the third situation you have, suppose it is operating below the break even. So break even below means what? It is undergoing loss. So loss means what? Interest cost is higher than the EBIT, isn't it? So before break even means EBIT is positive, but EBT turned negative due to high interest cost. See, interest cost is higher, EBIT is lower, ultimately EBT is become negative, right? That's why it is written EBT is less than 0, EBIT is greater than 0, interest cost is quite higher. So what will happen in this case? DFL will become negative, right? It will become negative because it is a ratio of EBIT upon EBT. So out of, you can see EBT is negative, so DFL will be negative. So this signal what? Loss amplification, means leverage is hurting you, right? It is not helping, it is hurting you. That is why I told you na, leverage is a double-edged sword. If you use it smartly, then it can be very helpful, but if you use if you don't use it smartly, it will be very much hurtful, like you can see in this case. So it since it is operating below the break even point, right? In this case you can see DFL is negative, your loss will become amplified. So more debt if you take, it increase loss instead of gain. So what we learned from this discussion is that it has been simply represented in the form of this chart, is that leverage can be a powerful financial tool, but only when used within the safe limit. Knowing where you are in this scenario help you manage risk smartly. So this break even point decide if you are above the break even, or if you are at least at the break even, you are safe. But if you go below the break even, you are unsafe. That means your DFL will become negative, your loss will get amplified. So this break even acts like a the brake, right? It acts like speed brake. It acts like your speed brake. If you go beyond the break even point, if you go in the negative side, you will be ultimately at loss. I hope that makes sense to you. Now friends, understanding the DOL, DFL we have covered completely, every aspect we have touched now. So now let's understand the DOL, degree of operating leverage. So degree of operating leverage can be understood very well using this particular diagram. So first of all, we will look at the formula. So DOL measure how sensitive a company operating income. So what is the meaning of DOL? It shows how sensitive a company operating income. So what is the meaning of company operating income? It means EBIT, earning before interest and tax. How sensitive a company operating income, that is EBIT, is to the change in sales. That is what is shown by DOL, degree of operating leverage. In simple term, if your sale move 1%, how much will your profit move? That is what DOL tells us, right? So again I am repeating, the formula is percentage change in EBIT upon percentage change in sales quantity. Means if your sales move 1%, how much will your profit move? That is what is indicated by the degree of operating leverage. Now friends, higher DOL, it means higher risk, higher reward. It signal higher fixed cost. It signal greater earning volatility. There are some key formula which we must keep in our mind. The first thing is contribution. I already told you that it is nothing but sales minus variable cost. Then the next formula we have DOL. DOL always reflect the operating risk. And then we have the fixed cost. What is fixed cost? What is the meaning of fixed cost? So fixed cost is the main driver. They stay the same even if your sales does not. Right? Obviously, fixed cost does not get impacted by the sale. Whatever your sales is, fixed cost will remain the same. So you should know how to calculate the contribution, because to calculate basically DOL, you will need to have contribution clear. Contribution concept should be clear, right? So percentage change in EBIT upon percentage change in sale, and EBIT you can write like sales quantity multiplied by price minus variable cost and subtract the fixed cost from it, right? So there is something called refined DOL formula, right? So you can say delta EBIT, or means change in EBIT, is equal to change in sale quantity multiplied by price into price minus variable cost. And finally, this is a super important formula that will help you to calculate, which is nothing but contribution upon EBIT, right? DOL. Like in the case of DFL, I told you the EBIT upon EBT. Similarly here, contribution upon EBIT. This is the final refined formula, and this formula we will be using most of the time. So understanding DOL help business plan better, price smarter, and prepare for the market shift. So if your DOL is higher, what does it mean? It means that your profit can skyrocket with a small sales jump, but it can also fall sharply if sale drop, right? So your suppose DOL is higher, it simply means that your profit can skyrocket with a small sale jump, but it can also fall sharply if sale dip, right? So that is the implication of DOL. Now the most important thing, how to interpret degree of operating leverage in a special situation. This is very important thing. So let's decode DOL when things get extreme. Let's explore how the degree of operating leverage behave in two very special and very opposite situation. The scenario number one is having no fixed cost, right? Having no fixed cost. So what does it mean? When a business has no fixed cost, it run purely on variable expense, right? Since there is no fixed cost, so it will run purely on variable cost or variable expense. In this case, DOL is 1, meaning there is no operating leverage, right? So when no fixed cost is there, which means business is purely running on variable cost, in that case DOL is 1, means that no operating leverage is there. The question is why no operating leverage? Because your profit move exactly in synchronization with your sale, so no acceleration effect is there. So it is a safe zone. That is why I have highlighted by green color. It is safe zone, low risk but also low potential for profit boost from increased sale. Obviously it is why it is called safe zone, because risk is very low, and but since risk is low, but potential for profit is also very low for boost from increased sale. Then scenario number 2 is EBIT is 0. This is very important thing. Now flip to the other extreme, when your business earn no operating income at all. No operating income earned by your business. Now the formula it very well. The formula is contribution upon EBIT. Just now I told you. So when EBIT is 0, means denominator is 0, so the DOL will become undefined, isn't it? DOL will become undefined, right? Since you divide by 0 in the formula, the result is impossible to quantify. That means maximum operating risk. A tiny drop in sale could send you into loss instantly. You are walking a financial tightrope, right? So this is called maximum operating risk. A teeny drop in sale could send you loss instantly, right? And you are walking a financial tightrope. So basically what we learned from this discussion is that, let's summarize the fact that DOL tells you how much your profit react to the change in sale. But in these these are two extreme cases. On one side we have no fixed cost when DOL is equal to 1. So on the other side we have EBT is equal to 0 where DOL is undefined. So in this extreme case, right, so DOL basically tells you how your profit react to the change in sale. But in these extreme cases, the message is clear. No fixed cost, you are stable. No EBIT, you are in danger. That's it. So this is the best way to learn, right? To comprehend the thing, to remember it for the long time. And if before the examination, if you go through these kinds of slides, you will be able to recall the main points, right? Now friends, have a look at this particular slide. How to manage leverage and fixed cost. Very important aspect. Here we will look at something called break-even point. I think you are familiar with it. So when it comes to running a business, the balance between risk and return often hinges on two key factors. The first is called leverage and the fixed cost. Yes, these are the two key factors, leverage and the fixed cost. Let's understand what are these two key factors here. So basically, first of all, let's talk about the high leverage case. See what happened. What is the meaning of high leverage? It means you are using more borrowed fund or fixed financial obligation. So whenever you are using more borrowed fund or whenever you are using fixed financial obligation, it pushes your break-even point higher, right? It pushes the break-even point higher. This increases the risk, okay, but it also opens the door to higher profit when things goes right. You can think of it as high risk, high reward. This is called high leverage. So I hope the meaning of high leverage is clear. That means you are using more borrowed fund or fixed financial obligation, right? So this more borrowed fund or fixed financial obligation pushes your break-even point higher, increases the risk, but also open the door to higher profit when things goes right. Then we have low leverage. Low leverage means you are playing it safer with few financial obligation. It lower your break even point and reduces the risk, but your return may also stay modest, ideal for a steady and stable growth. Then we have high fixed cost. So more fixed costs like rent, salary, equipment means your business becoming more sensitive to the change in sales. Right, your business is becoming more sensitive to the change in sales. So this amplify both gain and as well as loss. A classic feature of high operating leverage. And low fixed cost. Right, I told you, when zero fixed cost was there, DFL was exactly equal to 1. So low fixed cost means what? Reducing fixed expense add flexibility. It stabilizes your earning, cushioning both profit and loss. This is a strategic move during uncertain time. So the bottom line is that from this discussion what we get to know is that mastering leverage and fixed cost is not just about math. It's about making a smart decision that match your risk appetite and business goal. Right, I hope that makes sense to you. Now friends, have a look at the combined leverage. In this particular slide we will understand it. So what combined leverage is all about, it has been depicted clearly in this particular slide. So this metric that is the combined leverage tells us total risk exposure of a business. Right, it combines both operating and financial leverage. It tells you the total risk exposure of a business, total risk impact. As you can see, total risk impact or total risk exposure of a business. Right, so it combines both. Right, it combines your operating and financial leverage. So if we talk about the impact, on the left hand side you can see DTL stands for degree of total leverage. It captured the full risk impact by considering the operating fixed cost like rent and salary and financial fixed cost like loan interest. Now a high DTL, it means that even a small change in sale can cause big swing in the earning per share. It is both a great opportunity but a big risk also. Now have a look at the formula. Right, there are three ways to calculate DTL. First of all, percentage change in EBIT upon percentage change in sales. This is the first formula. Second formula is either you calculate DFL individually, DOL individually and multiply both of them. And the third thing you can do, DFL, DFL is EBIT upon EBT, DOL is contribution upon EBIT. So EBIT will get cancelled, it will be contribution upon EBT. So there are three formula which you can use to compute DTL. I use, depending on the situation what is given to you in the question, you can choose the either of this formula. No matter which one you use, it's all about understanding how sensitive your profit are to the change in sale. That's it. Right, now what is components, what are the things inside it? First of all, we have operating fixed cost, means cost that don't change with production. Then we have financial fixed cost, means payment like loan interest that are due no matter what. So together they define your company total leverage position. So combined leverage is like driving with both the gas pedal and turbo engaged. The reward can be huge, but so can be the risk. So handle it with insights. Now friends, that is all we need to learn from this particular chapter. I have provided you information regarding DFL, its implication, when it becomes zero, when it become undefined, when it become 1. So what are its implication we have already discussed. Similarly in the case of DOL also we have discussed, and finally we have also discussed the impact of break even point, impact of fixed cost, and finally combined leverage. That is all you have to do now. Now you just jump over to solving some more MCQs, because solving MCQs will give you confidence boost. Thank you.